Good morning, good morning, good morning, everyone. My name is Don Daniel, founder of P.I.L.L Method International, a better way to eliminate debt. P.I.L.L Method stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. Once you understand these four banking principles, you will know more about mortgages from this information than has been taught since 1936. 1936 was the very first self-amortizing mortgage. And I have somebody with me today. We're doing something new this year. We're bringing on a producer. Listen, we're gonna be giving a facelift to our YouTube channel. All kinds of things are going to be new for 2024. And our producer, Ruby, can you bring yourself on the stage so we can tell people who you are and what's going on, please? And she's coming up. She's coming on. All right. She's listen. If you want to go to YouTube, we're going to be putting. Let me put that link to the top of the page for our YouTube, and you go there to see this, because in a few minutes we're going to be shutting this all the way down here in Clubhouse and bringing everybody over to YouTube. So I'm going to put the link at the top of the page. All right. And so you'll have that. Here we go. Pin the link. And we're going to be able to add you to the conversation live on all the platforms, YouTube, Facebook, Twitter, and LinkedIn simultaneously. And we want to have that conversation live with you online. And those of you that are already watching us online, you'll be able to see a link in the chat if you want to come into the studio so that you can talk with us this morning. Good morning, everybody. Good morning, good morning, good morning. And we're going to get started here in just a minute. Danielle, I see that you have a Clubhouse birthday. So congratulations to you. We see your balloon. Good morning to everybody else. Tell us where you're from while we're waiting for the rest of the people to come in. Say good morning and tell us where you're from. All right. There we go. There we go. All right. So now, if you want to join us live, there's a link in the chat. If you want to be on the stage, if you just want to be just to watch what we're doing over on YouTube so that you can hear, that link is at the top of the page. Two different links. One link is to join us on YouTube, and the other link in the chat is for coming on stage and joining the conversation with us today. All right. So Sharon N. Jones says, good morning. Sharon, you need to, we're definitely will get you on stage and talk to you this morning. Okay. So here we go, ladies and gentlemen. We're getting ready to transition over right now to YouTube so that we can get everybody on stage and listening in. In just a couple of seconds, you won't hear anything else on Clubhouse. Everything is transitioning over to online on YouTube. So get that link, whether you want to join us in the conversation or you just want to participate by being a viewer. All right. If you want to be a viewer, that link is at the top of the page. If you want to get on stage with us and ask your questions and be a part of the conversation, which is definitely what we're looking for. I'm telling you, once we get into this conversation, it's going to be a lot better. And we have a whole history of how lending actually works, who's getting paid, who's making money, who's not making money, and what role we play in it. And the fact that this whole thing was put together not to help homeowners buy homes, but to save the banking system when the economy crashed in 1929. That's why we came up with the amortizing mortgage. And everybody got educated on it except the consumer. Oh my gosh, I think you're going to like this. I see people coming over now. And so we're going to put this in the chat. Let me put this in the chat. Come to YouTube because we're going to leave the room up. Come to YouTube. All right. And P.I.L.L Method Live. There we go. We got that. And I'm going to add that link so that you can come to us live. All right. All right. Hey, Steve, how you doing, man?
Yes, sir. I'm great. And yourself? Good to hear from you.
Listen, man, we're going to be, oh, I got folks, other folks who want to come up to the stage. Listen, folks, Steve, we're going to be doing something new this year and the next year. We're going to, people who want to speak to us and engage in the conversation, we're inviting them to come into our studio so that they can be online with us. And we're not going to be conversing here on Clubhouse. We're going to be starting it out on Clubhouse, but transitioning everything over to YouTube. Once you get to YouTube, everybody, make sure that you subscribe and that you like the videos and comment. Okay? I see you, Brenda. So I need to see you over on YouTube and make sure you come to the stage. I see you, Amos. I see you, Bernie, Eric, Hugh, Lala. I see you. Come on over. We're getting ready to transition now. We're turning the mic off and we're going straight to YouTube now. All right, ladies and gentlemen, we are on. So I'm hoping other people, if let's go ahead and put that link in the chat so that people will be able to come on stage with us. Ruby, if you would please. So come on up, folks. Come on up, and we're going to start with getting you on board here. So we're putting that link in the chat. So if you want to come on with us, click on that link and come into the studio with us. And I think that link works best in Chrome. All right. So come on stage with us right now. Just follow the directions and you'll be able to come on stage with us. All right. You don't have to turn your camera on. Okay. So Eric, I need you to come on. Please come to the, click that link and come to the stage. Good morning to you. And so this is a new process. Hey, Ty. Hey, Ty, what's going on? All right. All right. I hear you. I hear you, Ty. I hear you. Listen. This is what she has to say, ladies and gentlemen. She is at church, but she's ready to cancel these mortgages and other interest this year. All right. All right. So pin to the top of the YouTube chat. All right. So there we go. I need to see, let's bring these folks in. All right. All right. Armin is in there. It's not connected just yet, but let's see if we can connect your devices, Armin, so we can get you going. All right. So let me bring up the first thing that we're going to be talking about today. And I wanted to get some more people in here before we actually did that. So Ruby, let me see here. Let me see. We don't have, let's go ahead and get everybody here. All right, if you're new to the room in Clubhouse, we're transitioning over to YouTube. Everything is going to be over there. You will not be hearing anything over here in Clubhouse. Click the link at the top. If you just want to observe, And if you want to be on stage with us, there's a link in the chat to go on live with us. It's the one with the red dot. That one will bring you on the stage with us in YouTube. All right. Very good. All right, Ruby. So, Ruby, I'm glad you are with us today. Would you go ahead and kind of introduce yourself to the folks and because I want them to know who you are because you're going to be bringing something new and fresh to the Pill Method channel, YouTube channel, and our other social media outlets in this new year 2024. So go ahead and introduce yourself, please.
Hi, everybody. Good morning. My name is Ruby. I am from Colorado. I am a web developer, show producer. I do a couple different things. I'm a business consultant and software specialist. So I'm excited to get started with you guys. Help you guys get your questions online. You need information that the Pill Method is able to pretty much produce. I'm going to help you guys kind of situate that out, get them over to YouTube so you guys can start saving some money. So I'm just glad to be here. Thank you, Don, for allowing me to be a part of your production and your vision. And yeah, good morning.
All right, all right, all right. Thank you. Hey, listen, I see Eric has come on in. So let's get Eric up here. Eric, listen, man, how are you doing today? So you're going to have to go ahead and open your mic up and talk to us this morning. How are you, sir?
I am doing well. Can you hear me?
I can most certainly hear you. What do you think about this new format going into next the new year 2024?
Here, let me mute. I think I have YouTube open somewhere else. Let me mute it real quick.
Okay.
Okay. Well, you know me, I'm positive. You know, it's like I try not to. I like to assess things first, and not be negative about things. And oh, by the way, I want to say your shows have been right on point.
All right.
I missed Friday's show live, but I went back and listened to it later, and it was absolutely awesome.
Okay, tell us a little bit about that Friday show and what you got out of it.
Let's see. That might be a little bit difficult because, truth be told, I think I watched more than one show, so I may have them mixed up
Okay.
in my head.
All right. All right. Well, Fridays, let me see here. What was
Let's see.
Friday's
If you
show?
tell me the
The
subject,
title?
the title,
Uh-huh.
I
And
I will remember.
I got it. I got it. I got it.
See, the
Let
reason
me
why I like listening to the shows, especially
right.
replays and past shows, is
Mm-hmm.
because there's a little bit that you give every time that teaches you something, and it's something that you can put in your arsenal as far as learning about money and how to manage your money and whatnot. It's really great stuff. So a lot of times people may be reluctant to watch the replays and listen to past shows, but I have to say that you give, gems, you drop gems, on, I guess, you like a breadcrumb trail that will actually help you in a lot of situations. And also too, when you hear other people talk about money and people who claim to be gurus, you can usually spot a mile away when they say some erroneous things.
Okay. All right. Well, listen, man. Our show for Friday was Fast Track to Zero Debt. Mortgages, paying off mortgages and other loans in 7 years. Fast Track to Zero Debt. The one before that was Church Mortgage Glory, how to pay off your church mortgage in 5 years
And you talked about
without
that one
extra giving.
before.
Yeah,
You talked
yeah,
about the one, the fast track one.
yeah.
I do remember one talking point that you said that if there are certain things that you're worried about,
Yeah.
it won't matter anyway because the mortgage would be paid off.
Yeah. Okay. Okay.
Yes,
Yeah.
so I do remember that.
Yeah, I was talking about, I was in that one, I was talking about people who look to refinance. All right.
Oh yes,
Yeah. If they're
and you
looking,
talked about not putting down a large down payment as well.
exactly, exactly. So if they're looking to refinance, than these higher interest rates. What we told them there is, if you can afford the payment, all right, and you employ the techniques of the P.I.L.L method and the opportunity cost calculator, then what you'll find out is that most people refinance every 5 to 7 years. Well, if you have the P.I.L.L method, you won't have to worry about refinancing in 7 years, because most likely your mortgage will be done.
Absolutely.
Absolutely.
Yeah.
Okay. And listen, that was some, I really appreciate that information out. But today we're going to be telling the story of the history, of the sordid history of how this whole thing began. And if you want the links to this information, we're giving it out today for free. All right. Thank you very much for coming to the stage. Eric, did you have any other comments?
No, I'm just here to learn and listen as usual, and hoping to get some more gems. I know you've talked about this subject before, but I
Mhm.
know your presentations are dynamic in the sense of we don't know what you may cover, or I should say, the good things that you may cover, and so I'm sure there's something great that I'm going to hear to put in my arsenal, keep it in my back pocket.
Exactly, exactly. So what we're going to be doing now is we've actually incorporated Chat GPT into this particular show, so that we ask Chat GPT about amortization, about the history of educating the general public about how lending actually works, and you're going to be surprised at what you get here. And if you want that chat, we have a link for you to get that chat for you as well. We have Armin on the stage. Armin, how are you doing this morning?
Oh,
Hey there, Armin. How are you?
I'm doing fine. I'm just learning how to do this new method.
Well, listen, I'm so glad you're here, and we want to encourage other people that are listening to come to just come on and join the conversation and ask your questions about what we're going to be talking about today. But I want to thank you, Armin, for being here. You've come to quite a few of our shows.
Uh, yes, I have. Trying to figure things out, and hopefully next year is going to show me the results that I'm looking for.
Excellent, excellent, excellent. All right, all right. Did you have a particular comment or question before we jump into today's information?
If I'm just listening, should I just mute myself? Is that how it works?
That's exactly how it works.
Okay, so that's what I'm going to do, and I'll jump in when I have something profound to say.
All right, all right. So listen, folks, we want to start inviting you over. Come on up to the stage. We've got Eric on stage. We've got Armin on stage. Let's get you in the studio as well. Click that link and come to the studio. We want to have like a town hall in this next year, 2024, town hall style. This is kind of a, what would you call it, Ruby? Would you call it a run through a what do you do with the when you're doing a play? So we want to make sure that we're going to work out all the bugs now so that we can get into this thing. But right now, it has been going surprisingly smoothly to get into it. So let's go ahead and put that. We're going to put share the screen here, and the information that I've got here. Oh yes, that's the word, dress rehearsal. Thank you, Armin. I appreciate it. This is our dress rehearsal for our new format, our town hall style going forward. Anyone who wants to join the stage and be live with us online can now do that. All right, because we're bringing on a new producer who's going to help us to make that happen. Let's go ahead and share the screen. So what I have for you, ladies and gentlemen, is this is from the American Mortgage in history and international context from this article is from the University of Pennsylvania. All right. I need to share some of these things that are highlighted here. It says the mortgage debt was 15% of household assets in 1949, but it rose to 28% of household assets in 1979. And there are a lot of people out there that attribute the new way of doing mortgages as to bring us from a nation of renters into a nation of home buyers. All right. So that you can have your piece of the American dream. All right. It also goes on to say here, this enormous growth of American home mortgages, as shown in figure 1, has been accompanied by transformation in their form such that that American mortgages are now distinctively different from mortgages in the rest of the world. This whole thing, the self-amortizing mortgage, the way we understand it here, now got started here in the United States. That's where it started. It started here. So what we're going to be taking a look at is before the Great Depression. In 1929, that's when it started. Before the Great Depression, single family home mortgage was a very different instrument. All right. And here's what it looked like. You got your mortgage, you had to have about 30 to 50%, and sometimes as high as 80% down. All right. 30 to 80% down. And your payments were interest only payments. They were not amortized like they are today. Not at all. And you had a 3, a 5, sometimes even a 10-year term to pay interest only. And then you had a balloon payment at the end. If you could not pay the balloon payment, then the bank that you were with generally just refinanced the loan, gave you a new term, all right, a 3, 5, or 10-year term, and you continued to pay interest only. Now, what happened when, so during the Great Depression in 1929, when the market crashed, the banks, says here, but during the Great Depression in the early 1930s, property values in the United States declined by 50%. Wow. So if the property values declined by 50%, the banks were not going to refinance those loans anymore because the equity was gone that you were borrowing against. So you created the equity by putting your 30 to 80% down, and then they would finance the rest and give you interest only payments. If you were to default, then what could happen at that point is then they could sell the property at a profit and the bank would still make money. But when those property values declined by 50%, then when at the end of your term, now here's the thing, most people think that people lost their properties because they couldn't make the payment. They could make the payment, but what they couldn't make was that big balloon payment at the end of their term. And since the banks were no longer refinancing these loans because the property values had plummeted, then they lost their property because of the balloon payments. Okay, so now here's what else happened. Typically, let me see here. A wave of foreclosures resulted, typically 250,000 per year between 1931 and 1935. The worst of the depression, nearly 10% of the homes were in foreclosure. All right. Now, what happened next is very, very interesting. What happened next is, in response to these calamities, the federal government, that's under the New Deal. When FDR became president, this is part of the New Deal. In response to these calamities, the federal government began intervening in the housing finance market. It created the three particularly important institutions: the Homeowners Loan Corporation, HOLC, the Federal Housing Administration, the FHA, and the Federal National Mortgage Association, FNMA, or Fannie Mae. Okay, so these things got started at this time right around 1936. The Homeowners Loan Corporation raised funds using government-backed bonds. They used those government-backed bonds to raise funds, and they used the funds to purchase defaulted mortgages from financial institutions and then reinstated the mortgages. All right, so the government bought up that bad paper, all right, and then reinstated the mortgages. But how did they reinstate them? This is where it gets interesting. How did they do that? Here's how they did it. The HOLC changed the terms of the mortgages drastically, converting variable rate, short-term, non-amortizing mortgages into fixed rate, long-term, 20-year, fully amortized mortgages, meaning that once you start this 20-year journey on this mortgage, at the end of 20 years, the debt was paid. There was no balloon payment. Okay? Now, what happened as a result? An amortizing mortgage is one where the principal is repaid over the life of the loan so that the borrower does not have to face large lump sum payment at the end of the loan. The HOLC ultimately purchased, reinstated, and converted 1 million mortgages. Now, let's get into as to why this happened. Because the federal government did not see itself as being in the business of holding mortgages in the long term, watch this, it needed to find a way to make these mortgages marketable. They needed to find a way to sell the mortgages that they now owned. The government needed to sell the mortgages. So watch this. In particular, investors in mortgages wanted assurance, watch this, that they would receive the full principal balance, because this created a secondary market so that the government could sell the mortgages to investors. And investors wanted two things. Here's the first one. They wanted to make sure that they could receive the full principal balance and the scheduled interest payments. What was the scheduled interest payments, ladies and gentlemen? The scheduled interest payment. Oh, Ruby, I have to plug in my computer. Hold on. There we go. What was the scheduled interest payments? The scheduled interest payments were for 20 years. So this is what made mortgages so attractive to investors, because now they can get whatever the interest rate was, 4, 5, 6%. They can count on getting that money for the next 20 years. Now, this whole idea of mortgage, the new term now that we need to learn is mortgage-backed securities, or securitizing mortgages. This is how the deal is done now. How many of you, and I need you to start coming to the stage, all right, here in YouTube. We're going to repost that link, all right? We're going to repost that link right now in the chat so that you can easily find it. Come to the stage and start talking about this important information. Okay, so what happened as a result? That mortgages were now being bought by investors. How many of you have received a mortgage and within a week or two found out that your mortgage has been sold? Okay, put it in the chat. If you got a mortgage and within a week or two of you getting that mortgage was sold to somebody else, I need you to put a number 9 in the chat. Put a number 9 in the chat. Okay. And if you want to talk about it, come to the stage. All right. That's Armin said, put a 9 in the chat. Eric put a 9. All right. Who else? Okay. All right. So here's what we need to do. Here's where else we need to go with this. Okay. Let me see here. While some private mortgage insurance companies, some private mortgage insurance companies were in the business for that purpose before the 1930s, they were insufficiently capitalized and failed in the early 1930s. Consequently, the government established the Federal Housing Administration, FHA, to provide mortgage insurance. This is where your PMI got started as well in 1936. Private mortgage insurance started by the Federal Housing Administration. It made it very popular at that time. So what is happening? Mortgages are now going to 20-year mortgages. Their mortgages are now being sold to the investors. The investors are now looking to get two things. One, I want to make sure I get my money back. And what was their insurance? PMI. What was the other thing they were concerned about? If I'm going to get into this thing, I want to make sure I get my mortgage interest money for the next 20 years. They wanted their scheduled interest payments. Okay? Two things. Now, let's get into this next part. Thus, the invention of the fixed rate, self-amortizing long-term mortgage was above all else. Oh man, if you all don't hear anything else, please hear this. Thus, the invention of the fixed rate, self-amortizing mortgage, a long-term mortgage, was above all else a response to the federal financial crisis, as opposed to a design for the promotion of home ownership per se. In a lot of books, you'll read that this whole thing got started to promote home ownership. It is not true. It wasn't true then. It's not true now. Home ownership is a way for banking to make trillions of dollars. And let me tell you something about your bank right now. If you have your mortgage with Chase or Wells Fargo or Regions or with your local credit union. My goodness, ladies and gentlemen. This thing is about making money. And I don't care whose name is on your mortgage. That mortgage has been sold. You may be paying Chase. You may be paying Wells Fargo. But if you call on Tuesday, you call your bank who has your mortgage and you're paying Chase or one of the big banks or one of the big mortgage companies and find out who really owns your mortgage. You will find out that your bank is just facilitating the payments for mortgage investors who bought your mortgage. Okay, they're just facilitating the payments, but that money goes to the person who the companies that invest in mortgages, and they're afraid of only one thing. The only thing that they're afraid of right now, and we're going to get into that. Let's find out what they're afraid of. Okay. So let me see here. The combination of the HOLC and the FHA represented a piece of early financial engineering that allowed illiquid financial institutions that weren't doing well, okay, to become liquid again. At whose cost? Who's paying to make these financial institutions whole again? The American consumer. So investors bought the mortgages, and now you as consumers are now paying the investors. So your bank literally does not make money from the interest on your loans. They don't. They establish the loan with you, they establish the mortgage with you, and then they sell the mortgage at a premium. If you have a $300,000 mortgage with your bank, they sell it to investors for more than that. That's where they get their money. They make their money on the fees that they charge you to set up the whole thing, and then they make even more money when they sell it to investors. Why do they do that? I'll tell you why. Because not even Chase Bank has enough money to fund all of the mortgages that it has started. Not even Chase Bank has that kind of money. It would run out of money trying to fund all of the mortgages that they have in their portfolio. The only way that they can do it is to establish the mortgage and then get their money back. And they can't afford to wait 30 years to get all of their money back so that they can recirculate that money. They want their money back within a week or two so that they can put it right back out there to lend to other people who want mortgages. Our country, the United States, is one of the only ones that does this kind of deal where investors are actually buying up the mortgages. Other countries like Canada, can I tell you how Canada does it? Here's how Canada does it. Because they don't have fixed rate mortgages for consumers, primarily in Canada, they're mostly variable rate. And in Canada, you have to refinance your mortgage every 5 years. You have to do it. It's part of the contract. So if you were in Canada and listen, and here's what happened just recently. Canadian mortgages are traditionally low interest mortgages, like 1 and 2%. But if you had a variable rate mortgage, guess what? That mortgage went to 5, 6, and 7% when you had to get it refinanced at the end of your 5-year term. A lot of people suffered as a result of that. Now, here's another thing that happened in Canada that doesn't happen here. Okay, so Eric, I want to bring you online to talk about your questions so that everybody can hear. Here's another thing that happened with Canadian mortgages because of that. If you had a fixed payment, not a fixed rate, but a fixed payment, so that even though the interest rate increased, so that you can keep the same payment or close to the same payment, that meant that they had to change your amortization schedule. And if you go and search this now, you'll see it. Some of these mortgages had to go to 90-year amortization, from 25-year mortgages in Canada to 90-year mortgages in Canada. Go search it, Google search it right now. All right. I'm telling you, that's what happened in Canada. So Eric, you had some questions about that, or points you wanted to make.
Did you say questions?
Well, you had a point. You had a point. Some points you were making here in the chat.
Well, I mean, I was saying that they're probably either afraid of default, as far as the person who's paying the mortgage defaulting on it,
Mm-hmm.
and then the other thing is all of the money that they've paid the bank in order to purchase that mortgage. They're probably afraid of one of your principles that you teach us to use, which I will leave to you to tell.
Mm-hmm. Okay. So listen, they're definitely afraid of default, but there's something in place to help them with that. PMI.
Okay, the private mortgage insurance. Okay.
Exactly. Exactly. So that's not their major concern, getting their money back. Not their major concern at all.
Well, with the other point that I made
Yes.
over in the chat
Mm-hmm.
was the fact that the banks are getting rid of the risk.
Mm.
So by them selling it, it gets rid of the risk. Like you said, they don't have all the money, but it frees up money for them to lend out more money to set up more mortgages.
Yes.
So it's a cycle. It's like a machine, and I'm sure somebody somewhere way back when they sit in boardrooms or whatever and figure all this stuff out, and the public is not any the wiser.
Oh.
It's like we get into this stuff and we don't realize what we're getting into.
See, here's the thing. That's the point we're trying to make here, Eric. Is where is the education for the consumer? The banks are making money. The investors know how it works and they're making money. The people who are in charge of getting the mortgage insurance, they're making money on the deal. But where is the education for the consumer who's getting the mortgage and how it actually works?
There is none, because and when you mentioned the New Deal, FDR's New Deal,
Right.
I remember, even though it's been some years, I remember in my U.S. history textbook them talking about FDR and the New Deal. They mentioned the New Deal, but they never explained it like this.
Yeah.
Not the way that you're explaining it.
Well, see,
It's absolutely amazing.
well, the thing is that this history is out there to be researched. And after years of looking for it, we actually find some of this information that's out here. And in fact, we have some information from Chat GPT that we're going to be bringing up in a few minutes. Okay. So
Okay.
check this out. Check this out, ladies and gentlemen. The Homeowners Loan Corporation, having performed its task, was disbanded in 1936. In its place, the Federal National Mortgage Association, Fannie Mae, okay, scrolling down, which would later be Fannie Mae, was invented as a government agency in 1938 for the purpose of abetting a secondary market in FHA mortgages. And I thought that word abetting was key here. All right. And then I actually looked it up. All right. I'm going to do this for you. I'm going to look up abetting right here. ABETTING. All right. And we're going to get a definition of abetting. All right. And I'm going to bring that over so that you guys can read this. I thought this was so funny. Here's the very first one that comes up. Encourage or assist someone to do something wrong, in particular to commit a crime or other offense. And that was the term that was used here to talk about what was happening to the mortgage industry for us. Listen, I am so glad that you're here, everybody. Go ahead and click on, I need you to, what we're doing here is, what do you call that? Join the P.I.L.L Method channel, subscribe to the P.I.L.L Method channel. All right. Like the video. Okay. Go ahead and click on like for us. And also comment. And please, You now have the ability to come to the stage and interact with us. Click the link, all right? And it's at the top of the chat, but click the link, and we're going to be putting that link in there every now and then. Click the link so that you can join this conversation. You may have something to say. We have a bunch of people in here right now. Let's get you into the conversation. You don't have to sit on the sidelines anymore. I got Edward Street in here. He's making comments. And let's see if we can get Eric to come to the stage. All right. So Ruby, let's every now and then, let's go ahead and put that link in there. Eric, if you're not speaking, you can go ahead and mute your mic.
Okay. Thank you.
You're welcome, sir. We appreciate you. All right. Now, folks, let's get back to the information here. Okay. The information that I promised you. All right. Let me see here. Let's see. In particular, Fannie Mae issued bonds for purchasing mortgages at par so that investors in affluent communities could invest with confidence in mortgages in communities with little local capital. Buying at par meant banks had no exposure to interest rate risk when the lending term and funding of these loans by Fannie Mae issued bonds. The mortgage market changed little in the 6 years following the invention of Fannie Mae. The depression the depression, the late 1930s, and World War II were all times when housing market had relatively little construction and few transactions. In 1925, new home construction in the United States peaked at 937,000 units. This total fell to 93,000 units in 1933, and in the 1925 peak, it was not surpassed. In fact, was not even approached until after World War II. Now, World War II is now on the scene. What happened after World War II is going to change everything for us. Our producer, Ruby, has just put that link in the chat one more time so that you can come to the stage and join this conversation. We want to have a new way of working this whole program in the future. We want to have questions and answers. We want to be able to get you into the conversation and have sort of like a town hall meeting on these things. And if you're already on stage, go ahead. You can open your mic and let Ruby know that you want to speak, and then she'll work with you. All right. So open your mic, and then she'll see it. You just start speaking, and even if you have to interrupt me, that's okay. Interrupt, and we can have that conversation. But I need you to hear this right now, because this is another key point in what's happening with mortgages. If you're in Clubhouse, you need to come to the stage so that you come over to YouTube so that you can hear us. All right, we need you to come to YouTube so you can hear and see what's going on. So where were we? Oh, here we are. Let's see here. Oh, with the anticipation of the end of World War II came the GI Bill of Rights, officially known as the Servicemen's Readjustment Act of 1944. Included within the GI Bill was the invention of the Veterans Administration Mortgage Insurance Program, a program that allowed veterans returning home to obtain mortgages with very low down payments. And in fact, now a veteran can get a mortgage with absolutely no down payment, zero down payment, zero. You can build up to a 4-unit from the ground up with no down payment. And there's no limit to how much money you can borrow. If you can afford to pay it back, There's no limit to how much you can borrow with the VA loan. It is one of, if not the best loan out there right now. It's amazing what it can do. All right. So, see, this thing, a program that allowed veterans returning home to obtain mortgages with very low down payments. The program was intended both to reward veterans, watch this, and to stimulate housing market construction. At about this time, the Federal Housing Administration, FHA, listen to this, very key, also sought to stimulate housing construction by substantially liberalizing its terms, meaning it made it easier for people to get loans, to get mortgages. All right. Now, here is the next step on a different color here. Watch this. In 1948, the maximum term of a mortgage rose to 30 years from an initial maximum of 20 years. In 1956, the FHA raised the maximum loan to value ratio to 95%. You can now borrow up to 95%. You could have like 3%, that 5% down. That's even changed. You can have 3% down now, 3.5%. So things are changing so that people can borrow more money. All right. From the initial maximum of 80%. It used to be had to have 80% down. Yeah, not no more. For a new construction, for new construction and to 90% for existing homes. However, the FHA did not retain a cap on the size of the loan it would insure. And in doing so, it allowed for private sector market mortgage insurance to develop high balance loans. Let me tell you something. Now that loans have gone to 30 years, wherein what we've read so far, the banks understand money, they're making money. Investors understand money, and they're making money. Private mortgage insurance companies understand money, and they're making money. Where in this is the education for the consumer? Have we covered that at all in this article? Have consumers been educated at all as to how these 30-year mortgages actually work? And I'm here to tell you that once you know how they work, you can literally pay off your 30-year mortgage with your current budget in 7 to 9 years and still enjoy a great lifestyle while you're doing it. Why in the world hasn't the information been given to us so that we can understand what has been going on since 1948 when they issued the first 30-year mortgage? No education, none, zero. I mean, listen, other than the P.I.L.L method, have any of you ever had a class on how amortization works and how you can optimize the interest savings on your loan so that you can easily pay them off in 7 to 9 years instead of 30 years? Have you ever had that class? Yes or no? Put it in the chat. Yes or no? Eric Toom says no. Anybody else? All right. Anybody else? Have you ever had that class? Don't you think it's important for us to actually know how this thing works? We're expected to know, we're expected to use credit cards, mortgages, car loans, student loans, and some investor somewhere is making a ton of money on loans that are being paid over 30 years or more when they could be paid off in 7. That's what the P.I.L.L method is all about, teaching people how this thing really works. But I wanted to end this year on the history of how the whole thing got started and who's making money and who's not, and who's responsible for making sure that a lot of people get rich. We are a natural resource where we can turn our blood, sweat, and tears, where people can mine that. I mean, like a gold mine. They can mine your efforts, your ability to make money. They can mine your efforts and then make money on interest your entire working life. A loan that should have been paid off in 7 to 9 years. Now, here's what's happening. You're encouraged to refinance your loan every 5 to 7 years here in the US. Americans don't have 30-year loans. They have a string of 5 to 7-year loans until they die. You individually, as a person, if you were to count up how many people have actually paid off a loan that you know, less than 10% of the people you know actually pay off a mortgage. Count it up. You can use all your fingers and all your toes. You can use everything you have. Just count it up. How many people do you know that actually paid off a mortgage that you knew had a mortgage? It'll be about 10% or less of the people you actually know. How is it that we're in a system where 90% of us are set up to fail, to do the very thing that we signed a mortgage to do, to actually pay it off? We're not taught any of this. None of it. Here's the truth, ladies and gentlemen. Let's get back here. With a strong expansion of the U.S. economy in post-World War II, okay, a period driving up incomes together with the new institution of long-term and therefore affordable fixed rate self-amortizing mortgages, home ownership expanded rapidly. Who's making money on the deal as home ownership expands rapidly? Who's making money on that? Okay, so I got this whole article here, and anybody who wants the link, we will send it out to you. We're going to put the link to this article in the chat so you can see the rest of it. It is important for you to know that when we get into this, where I want to get to that point where what are the real estate investors, what are they afraid of? Okay, I've got it highlighted somewhere. I think it's here. Prepayment. Oh, here it is. The U.S. mortgage market is one of only 3 in which fee-free prepayment is widely available. Watch this now. Look at this. The U.S. mortgage market is one of only 3 in which fee-free prepayment, meaning you can prepay without penalty, is widely available, and in only a few other countries, prepayment is of limited availability. Refinancing a mortgage is clearly much easier in the United States. How about that? Keep refinancing, folks. We'll never pay it off. The other thing is that we have fee-free prepayment, but we don't understand how prepayment actually works and what it can do for us, meaning you could pay the loan off early. And the reason why we're not taught how mortgages actually work. So if I'm going to pull up something here for you. It is the mortgage-backed securities. All right. And we got mortgage-backed securities, and then I'm going to put in managing prepayment risk. All right, managing prepayment risk. So we're going to search for that. I'm going to pull this over and I want to show you something here. Look at this. Mortgage-backed securities. All right. Prepayment risk of mortgage-backed securities. What is prepayment risk? Prepayment risk. Mitigating risk of prepayments. If you keep going down, there are thousands upon thousands of these articles. This is the other thing. Real estate investors, people who buy mortgage-backed securities or invest in them, this is what they're most afraid of. People who prepay. Right now, I need you to get this. People who invest in mortgages need this to be attractive to them. So the banks need for this to be attractive to the investors, so the investors will continue to buy this mortgage paper from the banks. Does this make sense to you? If you knew how little money it took to save a ton of interest, you would take advantage of that. And then it wouldn't be so attractive for real estate, for investors to keep investing in mortgages. This is why all of these articles exist today. I'm just scrolling down here. I've read a bunch of them, but I'm going to leave that for you to look up. Look it up. And when you see all the math involved in them trying to figure out what percentage of the mortgages I just bought, what percentage of them am I going to lose money on because of prepayment? We as a nation know that we can prepay, but what we don't know is that we can optimize prepayment, meaning you can actually pay off a mortgage in 5 to 7 years without sacrificing lifestyle. Watch this. You can do it easily and live well. And you can control how much interest you save per dollar applied. Meaning, when you prepay a dollar, when you put an extra dollar on principal, the way in which you do it, the amount of money that you pay, the month you pay it in, the day of the month you pay it on, and which loan you attack, you can increase the amount of interest that you save or decrease the amount of interest that you save by doing it either the right way or the wrong way. Here's what we have been led to believe. Anything you do to get out of debt is as good as any other thing you can do. Oh my goodness. Look at Eric looking up listen, Canada, Denmark, and the United States are the 3 countries. Eric, I'm telling you, if I say something, that brother's going to look it up to make sure I'm telling the truth. Oh my goodness. Let me bring something else up for you here, folks. I'm going to bring this up now. Okay. Let's see, what is, let me see here. Is this it? I'm going to bring up from the chat that I did earlier. And if you want this, I'll get it for you. Okay. The history. All right. We're going to bring it up on my screen. Okay. Here it is. All right. So I asked the chat. All right. Write a treatise on the self-amortizing mortgage, and it gave us this information. You can read it later. All right. Conclusion: the self-amortizing mortgage, a key to financial innovation, has played a pivotal role in shaping the modern housing market and broader economic landscape. This is the current information that's out there. But the truth of the matter is, this thing was put in place to make banks solvent, not to make it easy, not so that it would benefit the home buyer or the people who wanted housing in the United States. Housing is just another way for other people to get rich. So here's what I asked the chat. What efforts have been made to educate the consumer about how self-amortizing mortgage actually works? Here's the context, meaning that a 30-year mortgage, let's say at 3%, really means the consumer will pay back 51% of the money borrowed as interest. Most people are unaware of how much interest they will pay no matter the interest rate. We completely lose track of interest costs. Here's what the chat had to say. Educating consumers about the realities of self-amortizing mortgages, particularly in terms of interest payments over the life of the loan, has been an ongoing challenge. Various efforts have been made to increase awareness and understanding among potential borrowers. And then it goes and says, here are some of the things that it talks about. But these are things are general, nothing specific. All right. So as I read through these things, it says, well, that really doesn't teach the individual. So then I asked, do you know if there is any data anywhere that has ever attempted to teach anyone how to answer a question like this? If I have a $200,000 30-year mortgage at 6%, and if I prepay exactly $500, exactly how much interest will I save? Here's what the chat had to say. Okay. Answering a question like this, so I restated the question, involves understanding mortgage calculations. Ladies and gentlemen, have you been taught how to understand mortgage calculations? I know I wasn't. Okay. What else does it say? What else does it say? Understanding mortgage calculations and the impact of additional payments on the overall interest paid. Do you know how much interest you're saving when you prepay? I didn't know. What specific data or studies, it says, while specific data or studies focusing on teaching this exact calculation might not be readily available, watch this now, there are several resources, and tools that can help individuals understand and calculate these savings. The information can be compiled and put together. All right. It can be done. But have we been taught how to do it? Have we even been taught where to look to get the information? Okay. So let's go to my next question. So now the chat went so far as to try to figure out how to do the calculation I just asked. Look what it did. It says, I can demonstrate this calculation for a specific example of a $200,000 30-year mortgage at 6% with an additional payment of $500. Let's calculate the total interest saved as an additional payment. Watch this. The first time it tried analyzing error analyzing. It seems that the function I initially tried to use for this calculation is no longer available in the current version. Oh, so it says, oh, it's going to try again. When it tried again, error analyzing. There was an oversight in my code. Now, this is ChatGPT doing this. I mean, instantly can give us information. And it tried to calculate the interest savings on $500. Let me tell you, if ChatGPT had such a hard time doing it, let me tell you who can't do it. Your accountant can't do it. You give your accountant $500 and say, put it on your mortgage. Now tell me how much interest you just saved. Your accountant won't know. The person at your bank won't know. Do you know how many people have listened to us here on the YouTube channel? and went back to their bank and says, listen, if I gave you this money, how much interest will I save? Do you know they may have to talk to 5, 6, 7 people, and none of them actually know the answer to the question? They don't even have the software in their bank or credit union to tell you how much interest you will save if you prepay $500. And why don't they have that information? The people who own the bank do not teach their employees how a mortgage actually works. I got the evidence right here. So the chat tried again. It appears, when it tried again for the third time, it appears that I overlooked recalculating the total interest without the extra payment after adjusting the calculation method. I will correct this and provide the complete and accurate calculation for the interest savings. Let's proceed with this final correction. It had to try 3 separate times to give us this information. Okay? By making an additional one-time payment, all right, it says here that you would save approximately $2,484.43. Here's what you need to understand. This calculation demonstrates how even a relatively small additional payment can lead to significant savings in interest costs over the long term. In other words, by prepaying $500 on a $200,000 mortgage, even at 3%, you would save $2,484.43. I checked it, and it's true. That's how much interest you will save. I checked it out. It finally came up with the right way of doing it. So if it was so hard for Chat GPT to come up with the right calculation, how are we expected to do this with absolutely no instruction on how a loan actually works in the first place? How are we supposed to do that? All right, here's my next question to the chat. And we're going to give you the link to this so that you can pull it up. Given the previous data, how much interest would I save if I prepaid $603.30? See, you can prepay any amount, even if it's just the 30 cents. So here's the next question. By making an additional one-time payment of $603.30 on a $200,000 mortgage at 6% interest, here's how much interest you would save, $2,994.03. The reason why I put that in here is this. If you had that mortgage and you made the very first mortgage payment, the next 3 principal payments add up to $603.30. Because see, on every loan, they have a principal column and an interest column. And I asked the chat if I made the next 3 principal payments adding up to $603.30, what would that mean? Now, for you to understand what I mean here, let's pull up the amortization schedule, Brett Whistle here, and I'll do it for you. 200,000 at 6%. The payment is $1199.10. Here are the payments. $199.10 goes to principal on the first payment, then $210, then $201.10, and then $202.10. These 3 principal payments add up to $603.30. If I make this payment here and I prepay these 3, I don't have to pay this interest, or this interest. And it came up with $2,994, and it didn't round it off. The other program rounded it off. It gave you the 3 cents. But those 3 interest payments come to $2,994.03. This is what you need to understand about this. To pay your loan down naturally by $603.30, If you do it the way the bank wants you to, it would cost you $2,997 in interest to do it. But if you prepay the money, you don't have to pay them that interest. And I mean, it's a lot of interest, a lot. So what else did I ask the chat? Okay. In your database, do you have it recorded that any school anywhere actually teaches or has taught how to calculate the last example? Here's what the chat said. As of my last update, April 2023, there is no specific record in my database of a particular school or educational institution that explicitly teaches how to calculate the exact impact of a single additional mortgage payment, like the example you provided. Ladies and gentlemen, this isn't even taught at the Wharton School of Business. How in the world did we get to a point where we thought we understood this, but we have absolutely no information on it? And the people who we rely on to give us great information about finances, they haven't been taught either because it wasn't taught in their schools. How in the world were we supposed to know? What else did it say? Type of calculation falls under the broader subject of financial literacy, which includes understanding interest rates, amortization schedules, and the effects of additional payments on loans. Educational institutions, particularly at secondary, high school, and post-secondary, college or university levels, may cover these topics in various courses. So if it may cover, I had to ask a few more questions. So let's get down to my next question. With all of the math books, accounting books, mortgage loan officer courses, CPA education you have access to, is there anything directly written that would instruct an individual on how to calculate the interest savings as a result of a one-time prepayment as illustrated in my previous questions? Please confine your answer strictly to the question I just asked. Chat says, as of my last update, there is no specific documentation in my database that directly references a text, educational material, or course that focuses exclusively on instructing individuals on how to calculate interest savings resulting from a one-time prepayment on a mortgage as illustrated in your previous questions. Ladies and gentlemen, this is why my book, The P.I.L.L Method, is the only book on Amazon that even begins to approach this subject. If my book was in the chat, if my book was if they had downloaded my book, then I'd probably be trying to sue them like other people because the chat has incorporated their books into training the chat without permission. And there are a lot of lawsuits that are going on right now. Obviously, my book isn't in there. My book is the only one out of 33 million titles that even begins to talk about this. It's the P.I.L.L Method, a better way to eliminate debt. And we've got that scrolling across the bottom of the screen. Okay. So let's see what else it has to say. While the concept of calculating interest savings from additional mortgage payments is fundamental to understanding amortization, it is likely covered in various financial, accounting, and loan officer education materials. These resources typically present it as a part of a broader discussion on mortgages and personal finance, rather than focusing specifically on precise calculation method for a one-time payment. You see, you have to be able to calculate one-time payments so that you can optimize how much interest you can actually save per dollar. So what was my next question? We're going to scroll down here. Then, would you say with the current data available, you would with the current data available to you, that it would be impossible to optimize interest savings per dollar prepaid. Okay? Is it impossible to calculate this? What did the chat say? Based on current data available to me, it would not be accurate to say that it is impossible to optimize interest savings per dollar prepaid on a mortgage. While there may not, now get this part, while there may not be a widely recognized specific educational resource dedicated to solely to teaching the calculation of interest savings from a one-time mortgage prepayment, the underlying mathematical principles needed to make these calculations are well established and accessible. But do we know where they are? I'm letting you know that the P.I.L.L method has found that information and incorporated it in our opportunity cost calculator. It does exist in our AI, in our cloud-based computing platform. It does exist there. We've incorporated in there. Watch this now. Optimizing interest savings per dollar prepaid involves understanding and applying concepts of loan amortization, which is a standard topic in finance and mathematics. Here's how you can approach it. And it goes into its idea of approaching this. But when I read that, this is the next question I had to ask. It seems that information that would be vital to consumers to save the absolute most in interest that is mathematically possible has not been created and made readily available to the average home buyer. Would that be accurate? Here's what the chat had to say. Your observation is quite insightful. It is indeed accurate to say that. As of my last update, there isn't a widespread, easily accessible, and consumer-focused resource specifically dedicated to educating the average home buyer about optimizing interest savings through precise payments on a mortgage. Optimizing interest savings means this, ladies and gentlemen. Anybody can save money when you prepay. But do you want to save some money, or do you want every single dollar you have that you dedicate to prepayment to kill as much interest as it possibly can? Are you satisfied with saving some interest, or do you want to save the most interest that you possibly can? So, because the more interest you save, the more of your money that you work hard for goes to pay the principal, and a lot less goes to interest. I want you to think about this fact. If so much money is being made in this mortgage and loan industry, mortgages, credit cards, auto loans, personal loans, if so much money is being made, why isn't the consumer educated on how the thing actually works so we could pay less interest because we want to? Why can't we borrow money at a discount? Okay. What else did I ask the chat? Okay. Let me see here. You mentioned in point number 5, the role of financial advisors. Do you know of any books, courses, undergraduate or graduate business courses that are currently available to prepare an advisor to optimize interest savings or loans for a consumer? It says here, there are numerous educational resources, courses, and programs that prepare financial advisors to optimize interest savings on loans, including mortgages for consumers. However, these resources might not exclusively focus on optimizing loan interest savings. And that's what we're about, ladies and gentlemen. We all know that we can save money, but is there anything out there that tells us we can save the maximum amount that we should be saving? The answer is no. So what else did I have to ask? Let's scroll down to my next question. You gave me a broad answer of the possibility to be trained to do this work. My question was meant to be more specific. Do you know of any coursework that specifically teaches individuals how to optimize interest savings on loans through prepayment currently? I am not looking for possibilities. I am looking for specific courses titled to teach what I'm asking about. Here's what the chat had to say. There are no specific courses or educational programs that are solely and explicitly focused on teaching how to optimize interest savings on loans through prepayment. Most educational resources in finance, real estate, personal finance, planning cover a broad range of topics. And while they may touch upon aspects of loan prepayment and interest savings, they they typically do not concentrate exclusively on this area. Ladies and gentlemen, we've been sold a bill of goods. The education that we receive about lending is actually from the lenders. We don't have that information. It has not been given to us. It's not out there even to train the chat, to train the open AI. Where is this information that is so vital? Do you realize that the amortized loan is the most ubiquitous financial tool on the planet? And we're expected to use it with literally no education as to how it works and how we can take advantage of it. There's no education out there except for my book. And the education you receive here free on our YouTube channel. We got 2 years of education for you here. I need you to help me get this education out there. Would you please make it a point in this next year to share this YouTube channel, this information. If you're watching us on YouTube, Facebook, Twitter, LinkedIn, get it out there. So, folks, would you do this for me? If you want to come to the stage and talk to us about this, if you're watching us right now and you have something to say about this, we want to hear from you. What's your feeling on this? What's your feeling on this information that you're getting now? We listen. Even if you disagree, we want to hear from you. You don't have to agree. We want to hear all points, all sides of the question. Click the link, come to the stage, and talk to us about this. We want to have a full town hall meeting on these issues. So that the link has just appeared in the chat, so you can join us here on StreamYard. Okay, I need to go ahead and finish this up. Courses and programs in finance, whether at the undergraduate, graduate, or professional development levels, tend to approach this subject of loan prepayments as a part of a wider curriculum. There is no specific information out there to help the consumer. Okay, watch this. Here's my next question. Keeping in mind your last answer, for the average home buyer, would you conclude that most home buyers will pay more interest than they need to with the current known methods of prepaying available to them, since the optimization of interest savings is not widely known or taught? Here's what chat had to say. Your conclusion is quite reasonable. Given the specific knowledge on optimizing interest savings through mortgage prepayment given the specialized knowledge on optimizing interest savings through mortgage prepayments is not widely taught or known, many average home buyers are likely to pay more interest over the life of their mortgage than is theoretically necessary. Here are the few points to consider. And then the chat gave us some points to consider. All right. So you can read through that because we supplied you with the link so you can read the whole thing. Here's another question I asked. Taking into account your last statement, if an AI cloud-based computing platform were created to optimize interest savings on all loans, and an educational program was created to enhance the understanding of the average home buyer and or amortized loan user, would that be the beginning of a new industry that does not now currently exist, as far as you know, with the data now available to you? Listen to this. Yes, based on the data available to me, the creation of an AI cloud-based computing platform specifically designed to optimize interest savings on all loans, coupled with an educational program targeted at enhancing the understanding of the average home buyer and amortized loan user, could indeed be considered the beginning of a new industry. Thus, this industry would blend technological innovation with financial education in a way that is not currently prevalent in the market. Here are a few points that highlight the novelty and potential impact of such an industry. An AI-driven platform could analyze individual loan parameters and personal financial situations to provide tailored recommendations of optimizing interest savings, a service that goes beyond general advice and standard online calculators. Ladies and gentlemen, as you read through what we put in here, what chat is describing is the P.I.L.L method program in detail. Our opportunity cost calculator does exactly this. Number 2 point, scalability and accessibility. Leveraging cloud computing, this platform could be made accessible to a wide range of users, democratizing access to sophisticated financial optimization tools. We have the only financial optimization tool on the planet right now. We have the only one. The opportunity cost calculator is the only one that does this. Okay, we're going to put that on the screen here in just a few seconds. But as we go through all of this, we want you to understand what's going on here. Back to our screen. Okay. Integration of education and technology by combining this technology with an educational program, users would not only receive recommendations, watch this, but also learn about the underlying principles of loan management and interest amortization, potentially providing, improving financial literacy on a broader scale. Our clients receive coaching along with the technology so that they can understand what's actually going on. For the first time since 1936, consumers can understand and take advantage of the amortization schedule and the way loans are constructed today. Instead of banks taking advantage of us, we can now pay back not only your mortgage, but your student loans, your credit cards, your car loans. All of your debt can be eliminated in an average of 7 to 9 years, because we're going to show you exactly how not to pay all of that interest. You don't need more money to get out of debt faster, ladies and gentlemen. You just need to pay more interest. We're going to show you how you can give the bank back their money because you choose the timing. And it makes it impossible. Watch this. It makes it impossible for them to charge you the interest. How would you like to give back that money so that you save so much interest, it cuts the interest that the investors are looking for by 75 to 80%. Yeah, that part. That an AI computing system has already been invented that does all of this that the chat is looking for. Let's scroll down here. So this is that was the last question I asked. Okay. Point number 4, real-time and dynamic analysis. AI and cloud computing could offer real-time updates. Our program does that, and dynamic strategies based on changing interest rates, economic conditions, and individual financial situations. You need a program, not like a spreadsheet. You need a program that changes with the times and when life happens. When life starts lifing, you need a program that's going to change with you, just like financial GPS. Give it new data. Here are your new instructions on how to handle your finances. Our program does that. Here's number 5, market gap and demand. Given the current gap in the market for such focused and user-friendly tools and education, there is likely to be a significant demand among consumers seeking to minimize their financial costs. And number 6, potential for expansion, initially targeting home buyers and users of amortized loans. This industry could expand to include various types of credit and financial planning, further broadening its impact. You can put all of your loans into our program, and we'll help you to manage every single loan that you have to optimize interest savings so that you can pay off all of your debt in 7 to 9 years. And we've been actually doing this since 2004. But a lot of people haven't heard about it. But because of our platform, we already have millions of people who have subscribed to our program and are using it and are paying off their debt. It is the wave of the future. AI is here for finances. So what else does it have to say? Here's the last thing. In conclusion, the development of such a platform and educational program would present a significant innovation in personal financial management and could mark the emergence of a new industry at the intersection of finance, education, and technology. It would address a clear need in the market for more accessible, personalized, and comprehensive financial optimization tools and education. Let's bring it up on the screen right now. So I'm pulling it up. Do I have any questions about this? Please come to the stage, ask your questions, or put it in the chat. But you definitely want to see what we have here live on YouTube. All right. So let me pull this over, and you'll see now the only financial optimization tool that is powered by AI, that's cloud-based, that's readily available to consumers. It is the only one in the world. And there it is. And we've been doing this for years. We have thousands of people who have benefited from, tens of thousands of people have benefited from this program. And the P.I.L.L method has, over the last 18 years, has an A+ rating with Better Business Bureau with absolutely no complaints. 0 complaints. I'm losing my voice here. I'm so excited about all of this. And if you want this chat, we have the link for you. We have it in the chat. So let's go ahead and put that link to the chat for the chat all the questions I was asking the chat GPT. so they can read the whole thing. And you can ask some additional questions of the chat to see if there's anything else out there that is likely to rival what we have right here. This is showing that same $200,000 mortgage, a $25,000 car loan, $2,000 on a credit card. This program has already calculated the optimized interest savings to be $179,752. Because of the interest savings, John and Rebecca Jones here will be able to pay off all of that debt, $227,000 in 7.7 years, not by robbing the family of monies that they could use to actually create memories and have some fun. They're learning how to optimize all of their dollars so that they can live well, but the savings comes from the bank. By not paying the bank all of that interest, they are now going to be able to say, I have more of my money going to where it was supposed to go in the first place. It's supposed to go to pay down the loan, not tens of and hundreds of thousands of dollars going to the mortgage so that it's siphoning off our wealth. While you're looking at this, let me bring up that $200,000 mortgage again at 6%. And I want to show you something very interesting. Let me show you what happens in the first 7 years. In the first year, we pay this loan down by $2,456 and a penny, and the bank wants $11,000, almost $12,000 in interest just in the first year. In year 2, you pay this loan down by only $5,000, but pay the bank $23,700 in interest. Year 3, $7,800 goes to principal, while $35,000 goes to interest. Isn't that ridiculous? We lose track of how much interest we're paying, ladies and gentlemen, because it's designed that way. It is designed that we don't pay attention to the interest consumption or the interest cost we are involved in. And as long as we stay blind to interest consumption, we won't do anything about the fact that we're paying so little money to the house we bought and so much money to the mortgage company or the real estate investors that bought the mortgage. They want to keep their monies safe and sound. And with a lack of education out there, that's exactly what's happening. And this is why we're here, so that you can know better and teach other people that they don't have to go through this at all. Can I show you something else about this mortgage? Year 4. In 4 years, you pay this mortgage down by $10,000 and $46,000 goes to interest. In just 5 years, $13,000, this loan is paid down by $13,000. You pay out $58,000 in interest. Can I show you something that is off the chart crazy? Let's just say you have a little bit of money that you were actually able to save up. Do you know how many people I find that have $2,000, $5,000, $10,000, $20,000, $30,000, $50,000, $70,000 sitting in the bank? They have saved up the money. They've done well financially. If you understand prepayment here, if you take a look at year 1 on this loan, $2,456 and a penny. That's how much is paid towards principal in the first year if you follow this program. And you're going to pay $11,933.19 in interest if you follow the bank's program. That's every month you pay us on time. You're paying your loan down by these $200 payments. Isn't that ridiculous? Out of the money you're spending, this is how much goes to principal. The rest goes to interest. And you know what's crazy about this? Even though it's divided up in principal and interest, do you know why the real estate investors, people who invest in mortgage securities, The payment on this is $1,199.10. The reason why they're so scared is because they get all of the money. They get all $1,199.10. What they're looking for is that each time you give them the entire mortgage payment, which goes to the real estate investor, only this much is subtracted from what you owe. So you have to keep paying the investor for 360 payments. That's 30 years worth of payments, because so little is being taken out of the payments to actually bring down your balance. But the real estate investor gets the whole amount. They don't just get the principal. They don't just get the interest. They get all $1,199.10. But they don't want you to prepay, because that will cut down on the number of times they can get that $1,199.10 from you. Here's what I mean. If we can pay this much in 1 year, that's all the principal payments added up. All the interest payments added up is in this column, cumulative interest. Oh, by the way, Ruby, let me put this in. Let me put this in the chat. I'm putting this in the chat, ladies and gentlemen, for you all, so that you can play around. This amortization calculator is what I use for teaching, and you can do this on your own and take a look at what's really happening, so you can keep track of your interest savings. Okay. Here's my question. If I'm going to pay this down by $2,456 in a year, do I have to give this money to the bank in 12 monthly installments, $200 at a time? Or if I had it, could I pay it to the bank all at once on line one? Let's see what would happen if we did. We owe $200,000. What if we paid the $2,456.01 up front? I'm not explaining to you how my program works. I'm explaining to you how the mortgage actually works. The information that the chat said is not readily available, we teach here at the P.I.L.L method. Okay? So we're going to take this $2,456 and a penny. We're going to subtract it from this 200,000, 2456.01 comes to 197,543.99. That's exactly the amount right here. What am I saying? If you paid this all up front, you could be paid down to here in 1 month, not 12. If you're paid down to here in 1 month and not 12, that means all the interest between line 2 and line 12 has been canceled, and your next mortgage payment would be on line 13 instead of line 2. If you gave the bank the 2456 all at once, what just happened? You just eliminated 11 mortgage payments you'll never have to make. That's 11 times the person or company that bought your mortgage. That's 11 times they won't get paid $1,199.10. In fact, you paid the mortgage down to here for not $11,933.19. You paid it down to here for only $1,000. This is why there's so many articles out there today about managing prepayment risk for people who invest in mortgage-backed securities. They are deathly afraid of you finding out this information and the tools to mitigate interest cost. Do I have any questions? Listen, folks, thank you for being here today. I'm glad that you were here. We're going to be doing more. We're going to be doing more shows where we want you to be a part of the show. So I've got Eric is no longer connected. Armin is still connected. Do we have any new people who have come to the stage who want to ask some more questions? Armin, you put a question in here. And it says, do you recommend drawing funds from an existing IRA? So Armin, you want to come on? You want to talk about that?
Hi, I'm here.
All right. So you're saying, you ask a question. Do I recommend drawing funds from an existing IRA account? I'm already in retirement to prepay existing mortgage. Can I show you something?
Sure.
Okay. Do you have an idea of how much you're making yearly on your IRA?
Lately, not much.
Okay. Well, let me show you this in this case. All right. So I'm going to show you the ROI for just investing in a mortgage, $200.10. Okay. So if I make my mortgage payment here and I prepay $200.10, I save this $999 in interest I don't have to pay. So here's what's going on. This is how we figure ROI. And if you can go to and Google it and ask Google, how do I figure ROI? And they're going to explain it to you just like this. What do you get out of it? You make $999 in interest you don't have to pay. What did you have to prepay to get it? Divide that by $200.10. Take your answer and multiply it by 100. Equals a 499% return on your money. Armin, do you know anywhere else you can get 499% return on your money?
No, it would make sense. I'm just trying to rationalize in my mind whether IRA funds are ripe for the picking.
You know, the thing is that you'll have an opportunity to do several different things here. But when you work with a program like the P.I.L.L method and the coach, you can come up with a strategy that makes sense. No, we shouldn't rob our retirement funds of all the funds because are some of those funds available to us so that we can have a balanced approach of saving for the long term and taking some of that money to save a ton of interest as well. We're looking at is not an either or. I mean, we're looking at a balanced approach and what can we do to help an individual like yourself figure out what is the right amount to put towards debt reduction and what is the right amount to put towards long-term savings.
One of the reasons I'm asking is I don't know where the IRA balance gets entered in the opportunity cost calculator.
Okay, it doesn't get entered into that is math that you do with your coach. Remember that when the chat GPT suggested that a two-prong approach, technology and education. So when you meet with your coach, then you can go over that and your coach can help you to find out what is what's the term I'm looking for? Critical point analysis. To do the critical point analysis to figure out what is that sweet spot of money that needs to go into to your retirement funds and how much should go towards debt reduction and interest savings. So I can help you to do that.
Okay, sounds like I need to have an appointment with my coach.
Yes, you need an appointment with your coach. And Armin, it sounds like you are a client of the P.I.L.L method.
Yes, I am.
All right, excellent. So I have M. Bolin on the stage. M. Bolin, come on up here. What do you want to talk to me about today? Open up your mic. Or did you just want to sit on the stage? I hope you're there. Can you open up your mic? All right. Oh, so there you go. It says there. Okay, there is a question. There's a question here. It says, if I don't get a late payment charge until the 16th of the month, would it be best for me to make my mortgage payment on the 15th instead of the 1st? I'll tell you this. I'll tell you what I do. I never, ever, 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 ever make my mortgage payment on the 1st. I can use that money for the next 15 days and make interest and do whatever I need to do. I can leverage that. And if it doesn't cost me anything, why should I pay on the 1st? And Bolin, I think that's a great question. I never pay my mortgage on the 1st. In fact, it is true that if you look at your mortgage, if you look at your mortgage statement more closely, you get a 15-day grace period, which means from the 1st, you get 15 days. So your payment is not considered late till the 17th of the month. I usually pay mine on the 16th, but you have to be careful. You have to be careful if your payment, if the 15th or the 16th falls on the weekend, you may not be able to make the payment and have it count. So I have mine automatically taken out so that no matter, I can always pay my mortgage later in the month. So even if my last day of my grace period falls on the weekend, I make sure my money gets to the bank before the weekend in any given month. So I won't have to get hit with a late charge because they didn't calculate receiving my payment because it was the weekend. I hope that helps. Okay. All right. And Eric, did you have anything else you wanted to say to us before we get out of here today? Okay, I see you're connected again. Nope, not connected anymore. All right, so folks, listen, I want to thank everybody. Listen, please, 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 please put some fire emojis, put some hearts in the chat for Miss Ruby Hill. She did a fabulous job today as our new producer going into the new year, and we're changing our format so that we can have more people talking to us online. Also, we also have we're going to 2 days a week. We're going to Fridays and Sundays, so that we can prepare bigger and better programs for you. I appreciate all of you so very much for being here for our inaugural new program. And look for our facelift on our YouTube channel. And we're going to have a whole bunch of other stuff for you on YouTube where you'll be able to become partners with us on YouTube. That you're going to be able to get all sorts of benefits for partnering with us on our YouTube channel. Listen, all of that's coming in the next year. All right. So if there are no more questions, I want to share this with you as the last thing today. I want to bring up my digital card, which is ice10k.com, ice10k.com. I'm also going to put it at the top of the screen. Now, ladies and gentlemen, we kept the audio on Clubhouse this time, but after today, the audio for Clubhouse, we're going to get started on Clubhouse, but we're going to shut the audio all the way off on Clubhouse. You're going to have to come over to the live stream to watch it on YouTube after today. All right. So here is my digital card, ice10k.com. And I'm going to put it at the top of the screen here as well on Clubhouse. Pin that link. All right. ICE, the number 10, the letter K.com. All right. Click that link, ladies and gentlemen. I need your help in getting the information out. I need your help in getting the information out. I click on become an affiliate right here. become an affiliate. It only takes 15 seconds to fill out. Put your name, your phone number, your email, and how you want to get paid, and click submit. You will not get confirmation immediately, but during the next week, we will send you out an email giving you instructions and information on the next affiliate training. Affiliates can make between $300 and $3,000 a month just sharing the YouTube channel with others. There's no selling, no selling, just sharing that. Okay. All right. So also, if you want to get this education, if you would like to know more about our cloud-based computing platform so that you can optimize your interest savings, the only one in the world, not even ChatGPT knows about it yet. The only one in the world that does this, that's recommended, that Chat said that if you had this, it would be an innovation, it would be a new industry. Then get your savings and earnings report. Click on the button that's right underneath ET here. Click on that button right underneath ET and get your savings and report. Get your savings report for free. It's two. You do. It's 2 steps. Follow the first step. Put your information in, and then confirm that information is correct. And then once that's done, it will let you into part 2, where you put your financial data in, and we'll let you know the month, day, and year you'll be debt free and how much interest you can save. And then what small percentage of your interest savings pays for your lifetime program. We want to take money that the bank was formerly going to receive to pay for your program. We're going to show you how to make the bank pay for your program. How about that? Okay. And here's the last thing. From the same card here, go down and click on Buy My Book. The only book on Amazon, even the chat says there's no information out there on how to specifically teach you how to save money on one single prepayment. This is the only book that does it. And from there, you can optimize your interest savings using technology and education. This book will lead you to the tools that you need. So get the book. All right, ladies and gentlemen, that's going to be it for today. I want to thank everybody for coming in. And Steve Max says, what's the time? The time is going to be, it's 8 a.m. Eastern for the weekdays, 8 a.m. Eastern, 7 a.m. Central Time, but the replays will be up, okay? If you can't make it during that time. And on Sundays, we're here at 8:30 a.m. Central, 9:30 a.m. Eastern. Listen, so come and join the show. We want to have more ideas. Put your ideas for the shows as well. I'm going to give you our email at info@thepillmethod. .com. info@thepillmethod.com. All right. That way you can give us your show ideas, and then come on stage with us. We want to have a true town hall experience online from now on, like a call-in show, as it were, to bring any financial question that you have, and let's see if we can answer it. If I can't answer it, I will tell you that I can't, when we'll bring on another expert that can answer your question. All right. It says, do I have to pay for coaching? Listen, bring your questions here. You never have to pay. You call us during business hours. Gilbert Cooper says, do I have to pay for coaching? You call us during business hours. Now you're paying. Okay. Our initial coaching appointments is $250 an hour. Guess what? You can ask the same questions that you would ask in a coaching session. You can ask that here for free. But what you call us during business hour, listen, it ain't no more free. It ain't free because we're a business. All right. I want to thank you, everybody. Happy New Year to you all. This is the last show of this year. We're going into next year doing something huge. And I want to thank Miss Ruby for helping us not only with running the show, producing the show, but she's going to help us with our social media. She's going to be helping us with, revamping our look on YouTube and on Instagram and other social media. She's going to be fantastic in that. And when you see what she does, you may want to reach out to her as well to give you a new look as well. So thank you very much. Listen, we're gonna hit the ground running for next year. Happy New Year to you all. The last thing you're going to see is we're going to run the commercial from Eric Thomas, and then we're going to do our outro. All right, ladies and gentlemen, I'm looking for any other questions. All right. I appreciate you being here. Ruby, thank you so much. Thank you so much to everyone. Let's hear from Eric Thomas as I say goodbye and Happy New Year to you all.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down from my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.